And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well. Hope you're taking some time for yourself, and may I just say welcome to today's program. Today, we're going to be discussing the Federal Reserve, and really, this came from a question submitted by a gentleman by the name of Jay. Now, if you have been listening to this program or maybe watching the podcast, I always welcome questions from all of you as listeners. You can go to Johnson, W-I-M, as in wealthincomemanagement.com. You can always post your question, and let's do this. If you post a question to the website, something that is relevant to all of us, as pre-retirees or retirees, something that is of interest, something that's truly relevant in what's going on in the financial and economic world of America and the stock market, well, I'm going to send you a free gift. We'll call it at that. We'll keep it a bit of a surprise. So if that's something that you'd like to get in on, by all means, go to the website, johnsonwim.com, and go ahead and post a question that you think is maybe something of interest to you as well as to maybe your next door neighbor, maybe some of your coworkers. And if I use that question on the radio show in the future, we'll go ahead and make certain to give you a gift. Now, today we're discussing none other than Jerome Powell, the head of the Federal Reserve. And it seems like the Federal Reserve has been in the news an awful lot. I talk a lot about the Federal Reserve within my book, The Capitalized Retirement. If that's something that you're not familiar with, I encourage you, find a copy and make certain that you go through that book. If you're coming close to retirement, it could be very helpful helping you understand how the Federal Reserve is so instrumental in the direction of our country economically. But we all know that the Federal Reserve has just gotten done with their meetings for the month of February. And as we go through and we look at the notes, it's pretty interesting. It's pretty revealing. And in some respects, it's also very concerning what the Federal Reserve is saying about the economic data that they're getting. We know that in this last meeting, they decided to hold interest rates steady. And I guess in many respects, that does not really surprise me. I don't think it probably surprises you either, because right now the Federal Reserve is, shall we call it for what it is, they're extremely nervous about what President Trump's agendas and what his initiatives and policies have been and what they probably will be, because they're afraid that he's going to put pressure on inflation not to go down, but rather to go up. And so as a result, they're keeping that interest rate at 4.25%, 4.5%, in order to be able to continue to keep what they call restrictive interest rate policy in place. And that's something that should be concerning to us when we think about everything that we have seen over the course of the last 3 to 4 years, where they took interest rates and they dropped them to zero in order to get the economy moving from the shutdown of COVID back in 2020, and then to ping pong to the other side, where they raise interest rates on us 11 times. I don't think in history, I could be wrong, don't quote me on this, but I don't think at any given time in history have we ever seen the Federal Reserve raise interest rates 11 times. It could happen. It could have happened in the past, but I'm not aware of it from my study of history. And so that was pretty monumental what they did. And they certainly have brought inflation down. We've seen that it's gone from nearly 10% down to where it is today. But the thing that's giving the Federal Reserve such major heartburn is that they're not getting that interest rate down to their target of 2%. Now, if you've been a listener to this show for any length of time, you know that I always thought that that was a little too elaborate. I don't think we need to bring inflation down to 2%. That would be great, but I just don't think that it's doable. I think it's a little lofty of a goal. However, the Federal Reserve doesn't think so, and so as a result, they're going to continue to keep this restrictive policy. But again, let's look at what's going on within the Trump administration. He's talking about tariffs. We know that right now we have tariffs that he's going to be moving forward with on Mexico and on Canada. We know that he's even trying to propose to Mexico to put tariffs on China, to put additional pressure on them. We know that we've already got tariffs on China, but now we've increased that to 10%. And so, those things, right, wrong, or indifferent, we know that that's going to have an impact on our economy. It may end up causing the cost of goods and services and materials and parts and supplies and that sort of thing to go up because of those tariffs. But we also know this, that right now there is a tremendous movement within the immigration policy of this country. And though many of us may say, you know what, it's okay, we have this absolute influx of immigration into the country, and it's doing very damaging things to the economy. And we could say that because there's facts to back that up. On the flip side of the coin, we know that if you end up taking and pushing immigrants back out of the country, well, that's going to leave fewer workers. And so the Federal Reserve is focusing on immigration, saying that that's a new dynamic, it's a new justification for them to not cut interest rates. But then let's face the fact that President Trump wants to also bring taxes down. Now, we know that we're all living as American citizens right now under the Trump tax plan, and we also know that it was going to sunset in 2026, and I don't think that we have to be terribly worried about a lot of change and the Trump tax plan not being approved for another length of time. I think that that's going to be rubber stamped and it's going to happen, but Trump's not terribly happy with the Trump tax plan. He would like to see additional taxes cut. And I think as Americans, we all want that too. That would be great. However, guess what? The Federal Reserve is using that as another reason for them not to cut interest rates. And here's the problem. When the Federal Reserve is looking at their own policies and they're considering their own policies to be restrictive, with interest rates high enough to be able to have an adverse effect. This is what they put in their notes, an adverse effect on some segments of the stock market, such as housing. We have to be somewhat cautious then at that point. It's kind of as if they're going to tell you, well, this is what we're going to do, and the surgery probably isn't going to go well, and there's going to be some pain in the recovery process. Well, they're telling us what they think the negative downside of keeping interest rates high is going to be. So that got me a little intrigued. I started looking into housing. And what I found was absolutely mind-boggling. Right now, the average American is paying, on average, between $1,600 to $2,000 a month for rent. And when you think about the average median income in America, the average family that is taking and they're earning a living in order to pay their bills, the average median income in America right now is $80,000 a year, $80,610 to be exact. Now I want you to think about that for just a moment. When 30% of your paycheck is going towards your housing bill, and then of course you've got taxes, federal and state, you don't have much left over. And so as a result, we have to go back and we have to really ascertain the direction of the economy. Is this going to be good? Are they playing chicken with President Trump? This is the reason why I believe President Trump wants to see interest rates come down. He wants to see those rates come down. Why? Because when you have higher interest rates, it has a negative impact on the economy. There's zero question about it. Now, granted, they're trying to thread this needle. They're trying to walk this tightrope where they're thinking that they're going to be able to have what they call the soft landing. I don't know about you, but as a financial advisor, a person who's involved in the market, we're involved in helping people to retire safely with more than enough income in retirement. I've almost gotten burnt out on this terminology of a soft landing. I've been hearing it now for literally years. But we think about the long-term side effects, the negative ones of high interest rates. Here's just a handful of them that we need to be thinking about. When interest rates remain high, and we may know this, but we may have kind of become desensitized because we've been involved in this world of the Federal Reserve with high interest rates. When you keep interest rates too high for too long, you now become very restrictive in the borrowing costs of American corporations. And you see, when you cut down on, or when you remain high in the borrowing costs from a corporation standpoint, let me ask you, do you have as much expansion as a business? And the answer is absolutely not. Now, ladies and gentlemen, this also affects you. It affects me. Because when we think about it, higher borrowing costs generally invoke a postponement on goals. So you want to buy the new car, you need a new car, but guess what? Interest rates are still too high. And so as a result, what do? You make that jalopy work, right? You make that car last a little bit longer in the hopes that interest rates are going to come down. And then guess what? If the jalopy gives out, well, you've just got to bite the bullet. Now you've got to go into debt. You've got to pay a higher interest rate than what you were anticipating or wanting to pay. And that bites even deeper into your wallet. We know that it also creates less ability to be able to invest for retirement. When more of the paycheck is having to go towards the cost of living, you're not going to feel it as flush at the end of the month. And so guess what? You're not pumping as much into retirement savings, which you should be. You've even got slower economic growth because you have increased debt burden by the federal government. Think about how much debt this country has, our government has. And remember that they are not immune to high interest rates, and interest rates staying higher than average. All of these things could be considered very negative long-term side effects if the Federal Reserve continues to stay on the stance. But are they going to do it? Are they going to cut? Are they going to hold? Are they going to hike? Well, that's the big question. So sit tight. We're going to be coming up to our first commercial break. We'll be right back. You're not going to want to miss the second half. And welcome to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining the program, welcome to you today. Today we're discussing the Federal Reserve and how this last meeting, well, it did not turn out the way that we would probably like. The Federal Reserve is wetting down their pant leg right now because they're very afraid, or so they say, of all the various indicators that inflation is slated to go higher because of President Trump and because of his initiatives and his policies. And though that could be true, what we need to be thinking about is the fact that the Federal Reserve has an absolutely rotten rate history. When we think about their record as a Federal Reserve, in over 100 years, they have not really had a great track record. They have held interest rates too low for too long, creating unreasonable inflation. They have compensated going the other direction, taking and keeping interest rates too high and throwing the economy into a recession. Now, right now, I don't have any major concerns about a recession, at least not in the near term. But President Trump is making it very clear that the Federal Reserve needs to work with him. They need to bring interest rates down. And right now, they seem to be in this plateau holding pattern where they refuse to give in. They refuse to even give us any indication that they're going to give us maybe one rate cut, and if they do, it's going to be at the tail end. Well, my question to you is the damage already going to be done by then? Is it going to be a position where one rate cut is, well, it's of really no side effect because they should have cut interest rates sooner? We know that keeping interest rates higher for too long can have very negative side effects on the economy and have very negative side effects on the average American family and on growing corporations in this country. And though so far the stock market's been able to shrug off this second meeting of the year, holding interest rates steady, well, as other things start to come into view, like earnings, and we start to see earnings declining, we start to see where tariffs are indeed going to cause the cost of goods and services and materials and supply items to corporations more money, and that's probably going to be passed on to us as consumers. What do you think that keeping these high interest rates is going to do to you? Well, the reality is that this is going to no doubt affect the economic growth. It's no doubt going to have an effect on the earnings potential for corporations in America. And so where we have seen the S&P 500 do extremely well in 2024, where we ended up getting a whole 1% of a rate cut, and that kind of set the tone for 2025 that we would see more. Now we have to be thinking about, well, what if they don't give us a rate cut? What if they don't give us any more than maybe one rate cut? Is that going to affect the stock market? Is it going to affect more of the growth-based companies that I'm investing in? So we want to talk about this in two ways. Number one, in the last radio show, I talked about, interestingly enough, when we pay attention to the stock market, we're starting to see what's referred to oftentimes as a broadening of the market. This is where the darlings of the stock market are no longer becoming such daily household names. People are starting to realize and wake up to the reality that maybe it's not smart to buy stock and pay, 40, 50, 60 times earnings. And so these stocks are very expensive. And we're starting to see where investors are beginning to rotate out of them because they realize, you know what? We've had a good run. Now it's time to take winnings off the table. So what do we need to be focusing on? Well, if you're not in retirement and you're still quite a ways away from retirement, this is where you can start to maybe begin to refocus your money on that of value stocks. And, value stocks are one of these sectors where, a value stock in basic description is the stock of a company that's fallen out of favor with Wall Street. They're very inexpensive. You can buy them at very reasonable price to earnings ratios. And the interesting thing about value stocks is the reality that most of them pay better dividends than most tech companies. In fact, most tech companies don't pay dividends, or if they do, it's very, very small. Now, why is a dividend so important? Why is a dividend something that I want to actually have in my portfolio if I'm not retired? Isn't it all about growth, Matthew? It's all about appreciation. Well, as things begin to economically cool, and that has an impact sometimes on the stock market, where the stock market begins to cool a little bit, and we're not seeing as many high highs taking place and records being set. We want to understand that you may not be expecting as much capital appreciation in 2025. And so let's say that you wanted to have 10% capital appreciation, but you know that this year it's probably not in the cards. You're going to maybe see 6 or 7% capital appreciation. But what if you can make up for that? What if you could make up with a dividend paying you 3 to 4%? Now, all of a sudden, you realize you've got something to work with. And not only that, when you get paid dividends, that's something that you can use that's cash to buy more. You know that I'm a big fan of dollar cost averaging. And with the cost of living going up, if you're one of these individuals where you simply have less left over at the end of every month, that can restrict the amount of buying that you do. That restricts the amount of money that you can put into your account every single month in order to be able to purchase more. And so my question to you is, why would you not want dividends to help you do that? Because now if all of a sudden you've got this silent partner that's paying you 3.5%, 4.5% in dividends, that's helping you continue to buy, now all of a sudden you don't have to feel as bad about putting less into your retirement savings. This is why it's so very important. If you have individual accounts, you have Roth accounts, you have individual IRA accounts. Maybe you had a job in a 401k and you've quit that job. Your 401k is now kind of dormant. It's just sitting there, and you're concerned that you're kind of handcuffed by the number of investments that old 401k allows you to invest in. This is a perfect opportunity for you to roll that dormant 401k into an IRA. And if you can begin to redeploy that money, buying stocks that are less expensive, stocks that are more of a value, hence the term value stocks, and you're able to get that dividend, that 3.5%, 4%. Now you've got something where you couldn't be contributing to that IRA. Now you've got dividends that are starting to contribute for you. You've got dividends that are starting to buy additional assets for you, and that helps you continue to purchase. Even though you may be, at a new job contributing to your 401k, you can make that IRA work harder for you. Now let's flip the coin. Let's think about what happens if you are retired. Well, if the Federal Reserve is absolutely married to this idea of keeping interest rates high, and you've got potentially a cost of living that you have seen increase because of higher interest rates, and you need more income to be able to pay for the things that you consume every single day. Let me ask you a question. Why wouldn't you want a portfolio that is producing more income for you? You see, so many conventional financial advisors that are out there, they've done a great job of teaching you how to focus on growth. But when you're in retirement, is growth your number one goal? Now, I really want you to think about that. Is growth your number one goal? Because the two things are tied to each other. Growth and risk are tied to one another. And if we want double-digit growth, we have to be willing to accept double-digit rates of loss if there's a pullback in the market. You've seen it, you've experienced it all throughout your working career. If you had a 401k or a 403b, do you still want to be taking on that same kind of risk, playing chicken with the stock market that's getting very frothy? I've been expressing to clients that right now the S&P 500 has an average PE ratio of 37. And if you're not familiar with the PE ratio, that's like you going out and buying an ice cream parlor for $3.7 million that only makes $100,000 of profit. You'd be bonkers. You'd be out of your mind to do that. And yet, so many times we get caught up in the hype, right? Our mothers asked us, if all your friends jumped off the bridge, would you jump off the bridge too? Well, it's a good question, because if everyone is still continuing to clamor and they continue to focus on the S&P 500, is that really the right thing for you to do if you're in retirement? Now your objective has shifted from growth to now income. So is there any reason why you wouldn't want to have more income? When you think about the freedom the dividends create for you, where you can have less stress, you can have less volatility, you can have less risk of loss because your portfolio is now sitting in more of the quality, more of the less risky stocks. And yet they're producing for you that 4.5 to 5 to even 6% in interest and dividends. Okay. And it doesn't even have to be stocks. You could be focusing on things like bonds. With the bond world reacting to what the Federal Reserve is doing, it's creating a tremendous buying opportunity for individual bonds where you can still buy them at discounts. Just think about, having $1 million of retirement spinning off $50,000 to $60,000 of interest and dividends. Could you imagine having an extra $5,000 every month to spend, knowing that that doesn't come at the expense of your principal? This is the reason why we want to take advantage today. The Federal Reserve seems absolutely lockjawed. They're not going to drop interest rates, and we know what the long-term side effects of these high interest rates can be. Lord willing, they don't shove us into a recession. That would be terrible. And certainly they would say that they didn't want that. But guess what? Their track record indicates that they have a propensity to do that. So doing some self-analysis, getting with a financial advisor that can help you ascertain just how much risk your current portfolio may be presenting to you in retirement, and then identifying how much more income you could get if you simply reduce the risk and you went into things that were more income producing, could be an absolute salvation in the increased cost of living in America today. We'll have to see where things go. But in the meantime, you can't control those. You can only control where you invest your money. So, food for thought. My name is Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.